Three headings so far: profitability, liquidity, and risk. We're looking to try and see what else can we find out about the business. What else can we say about how well or how badly the business has been run? So the first two then is return on capital employed. Do you know the formula? If you don't, you need to go back to the ratios and make sure you know. Okay. So there'll be ordinary shareholders' profit. Operating profit divided by the capital employed, all the money invested in the business. Are we making good profit or bad profit? The next two is return on shareholders' funds, or also known as return on owner's equity. So this is the money earned only by the money invested by the ordinary shareholders. Are we happy with that or not? We've looked at those before. If you're doing business, we've talked about those two as well. Okay. The next two ratios should be about the ability to pay debts. We're all happy about that. We've dealt with those before. What does the price-earnings ratio say? So the P ratio, I'm just going to, so price. What price are we talking about? It's the market price of a share. Remember we looked at this before where we said, if the earnings per share, how much profit has been earned from every share invested in the business? If that earnings is 5 cents for every share, you might expect a share price of maybe 50 cents, 60 cents. If you see a share price of 200 cents, so that we have a price earnings ratio of 200 compared to 5, so that's 40 to 1. It means that the stock market is very confident in the future of this business. We're not earning great earnings now, but loads of people want to buy shares in this business, so they must think something in the future is going to cause them to earn more profit. Maybe we've just invented something, so we haven't earned the profit on it yet, but we will be earning the profit on it soon. Okay? So we're trying to think about other headings other than profitability, liquidity, and risk at this stage. Now, if we tie together the debtors' months and creditors' months, so debtors' months means how long it takes the average for the debtors to pay me my money. So if my debtors are paying me my money in about 2 months, and I'm paying my creditors, so the creditors' months is 1 month, what does that mean about the way the business is being run?
Pay your bills sometime.
Pardon?
Is it if you can consistently pay bills on time?
Is it if we can?
Consistently pay bills on time.
It's not if we can consistently pay bills on time. Just think about the answer to the formula again. Debtors months, my debtors on average are taking 2 months to pay me the money that I'm owed. Okay? But I'm paying my creditors in 1 month. So what that means is I'm paying for bills before I get money in. Yeah? What does that say about the business? Okay. Nathan, he says he's going to sell me something. So what Nathan does is he goes out and he spends €10 and he buys the item. Okay? So he's spent the money, he's bought the item, he's down €10. He gives it to Corey and Corey turns around and pays him next week. So for a whole week, Nathan is down €10. His cash flow is negative €10. Is that right? So if my debtors pay me slower than I pay my creditors, I have a cash flow problem. What heading did we see already that talks about cash flow problems? Which of the three headings? Profitability, liquidity, risk? Liquidity. So this is a liquidity problem. If I'm paying people quicker than I'm getting paid myself, I've got a liquidity problem. Okay? Now, next one then is, so the next three, we put the three of those together. What's the difference between markup and margin? We would have seen this in a number of topics last year, tabular statements, the management accounting topics. What's the difference between markup and margin?
Markup is like the price it goes up, is it?
It's about price, yeah, okay. Okay, it's about profit and how we set our sales price. So markup is the profit compared to cost, and margin is profit compared to sales. Okay? So the gross profit percentage markup will be gross profit compared to cost of sales. Gross profit margin is gross profit compared to sales. Net profit percentage would be net profit compared to sales. Is that right? And back to what Nathan said a second ago, this is about price. How do we set our price? Now this is where we need to start thinking about looking at the top of the question where it tells you about the business that we're operating in. So if we're operating in let's say, a business selling jewellery, would we expect to be charging relatively high profit on each item of jewellery we're selling? What do you think? If you go into a jewellery shop and you buy an engagement ring, would you expect built into the price is a reasonably high profit?
Yeah.
I would think so. Now again, you're making assumptions based on what you think might be happening in the industry. You might assume slightly wrong. That doesn't mean you're going to lose marks. But what you're saying is, I assume in this industry, profits are reasonably high on each item. I'm not selling massive amount of engagement rings, so I'm not selling large volumes of product, but each time I sell something, I sell at a high price. Now, if you do the numbers for this, and you get a markup of, let's say, 10%, that's quite low profit. And if this business is operating in jewellery, you might say that the price structure that they've set is probably wrong for the industry they're in. They need to think about increasing their prices. Now, you've made an assumption that jewellery prices are reasonably high. Figure of 10% is relatively low profit. A figure of 50 to 100% is relatively high profit. I would expect if you're selling designer clothes, it's probably in the high profit range. So if you get an answer there of 10, 15, 20%, we're not charging enough for the industry we're operating in. Is that okay? So we're starting to look a little bit more about, because we're going to be reviewing questions 1, 2, and 3 now. We're going to be looking at, well, what do we know about the industry and what judgments can we make? Now the next one's then DPS and EPS. We're going to look at those two together. What do they stand for?
Dividends per share and earnings.
Dividends per share and earnings per share. Now, this is where we need to have a look at the previous one here. I'm trying to look at the difference between the two of them. Okay? So dividends per share comes from the ordinary dividends divided by the number of shares. Earnings per share is ordinary shareholders' profit divided by the number of shares. What's the difference? The difference between the two of them is retained profit. So there was one question that you did, and I think you got an answer for earnings per share of 21 cents. And for dividends per share, I got an answer of 7 cents. Now, put the two of them together. What does it mean about the strategy that the directors of the business have about the way the business is being run? So they've earned 21 cents for every share that's invested in the business. We're paying out 7 cents. So what's happening to the missing 14? It's going into the business, been retained. Now, do you think that's a good idea?
Yeah.
Why?
Good for the future of the business.
It's good, so it's very much thinking of the future of the business. And why will it be so good for the future, Jack? Why is it so good for us to pay out 7 cents and retain 14 cents for every share? It's not that we're making profit, no.
Is it that would show on the balance sheet or the profit and loss sheet, and it would be good for investments? Like, if at the end of the financial year, somebody wants to invest in stocks, they look at how the business is doing, they see that has a lot of money, and they might invest in it as well.
I think get back to think about what Robert's saying. Okay, you're not necessarily wrong, but go back to what Robert's saying. Why did Robert think that it was good for the future of the business? Sorry? So more money is invested, so this 14 is invested back in the business. What will we use the 14 cents from all of our shares? That big pot of money, what will we use it for? If we put it back in the business,
To buy things in the business.
so buy things. When we say things, we're talking fixed assets. So we're going to use that money to buy buildings and vans, which will expand the business. We could have paid for those buildings and vans by borrowing. But because we've saved the money, we didn't borrow. Why is that good for the future of the business? Pardon?
If you were to borrow, you have to pay back a bank.
Exactly. Now we don't have to pay that back. So that's good for the future of the business. Would your granny be happy with putting her pension pot into that kind of business? Yeah, she's getting a dividend. Yeah, a bit of dividend. Yeah, but the business is going to be safe in the future because they're not borrowing so much. And it does mean that when your granny is much older and she needs that pension pot, well, the business is going to be worth an awful lot more. They'll have more premises, more vans, because they've been saving so much. So that means the business is much more stable, really good investment. Does that make sense? Okay? So if you put those two formulas together, so dividends per share and earnings per share, put the two of them together, and what you're looking at is a thing called dividend policy. What is the strategy, the policy that the people run the business? Remember, we're all shareholders of the business. We've hired directors to run the business for us. The directors have chosen, let's pay out a bit and save lots, or do we want to keep the shareholders happy by paying out lots and only saving a little bit? That's the dividend policy of the business. Yep? Yep. So, if you compare the two of those, and if there's a big difference between the two of those, well, that means that the strategy of the people running the business, they're trying to retain lots, which is going to be good for the long-term future of the business. The shareholders may not be happy now because we're not getting lots of dividends now, but in the future the business is going to be worth more, and the business is going to be safer. What heading do we put that under? Profitability, liquidity, risk. It's actually more about risk, because it's about the long-term future of the business. But what we're starting to do now is we're starting to look a little bit about investors. Would the investors, either current investors or maybe future investors, so one of the questions they may ask in the leaving cert is, would you consider investing money in this business? Or they might ask you, if you are currently a shareholder in the business, would you be happy? So think of the wording of the question. So we have a new group of headings that we're looking at. So we have profitability, liquidity, risk. Now we're starting to look at the investors' ratios. Are the investors happy with their investment? Or is it a good share to think about investing in? Okay? Now, dividend yield, what that looks at, your dividends that you're getting out of the business. Can you remember the formula? Dividend yield. Again, you need to have a look at, you need to start getting the formulas into your head. These are one of the things you have to learn them off by heart. It's the dividend, the yield for something. If you read a newspaper that says there's a great yield on this investment, it means you're making loads of money on the investment. So it's good profit. So the dividend yield compares the dividends to whatever the market price of the share is. So if the market price is €1 and I've got dividends of 12 cents, I'm making a 12% return just in dividends. But if the earnings was more than dividends, well then that's a really good investment. Okay? So dividend yield compares how much I'm getting in dividends to whatever the market price of the share is. And again, it's something that investors might think about if they think about buying shares in the business. Now the dividend cover and interest cover. So when we talk about cover, it means how many times can our bill be covered or be paid from the funds generated. So the dividend cover is how many times did we earn the dividends than what we needed to pay out. So if we have a pot of 200 grand profit and we're paying out 50 grand in dividends, our dividend cover is 4 times. We're earning 4 times what we need to pay out in our dividends. The interest cover is the same thing. We're earning 4 times or twice what we need to pay out in interest. Now, interest cover of 2 times compared to interest cover of 10 times. Which would you, why is it one better than the other? Which one is better?
10.
Interest cover of 10. Why is that better? We're earning 10 times what we need to pay out in interest every year. Does that sound, what might that sound better? It's not just necessarily that we're making profit, but it is about profit, but it's about how much of a burden is the interest. If I'm only earning if I'm earning 1 times, it means my profit is just enough to cover my interest, and I'll have nothing left over. If it's 10 times, I'm earning 10 times what I need to cover the interest, so the interest is not a major problem. What heading does that come under? Profitability, liquidity, risk. Well, it's about profitability, but it's also really about risk. And interest is a risk. you guys are going to take out loans to buy your first car, probably. And when you think about, well, how much funds, how much wages will I have coming in to cover the repayments on the car? Well, if my wages are 10 times what my repayment is, well, then the loan to buy a car is not going to be a major problem. It's not going to be a major burden. You'll have loads of spare cash once you've made that repayment. But if it's 2 times, that means I'm earning twice as much as I need to pay out in repayments. I'm not going to have lots of spare cash once I've made my repayment. And what if I don't get overtime next month? I may have a real problem paying my repayment. Is that okay? So the cover, basically, those cover ratios talk about how much of a burden are the responsibilities of paying out my interest and paying out my dividends. How much of a burden is it? Okay. Now the dividend cover is very similar to the comparison we did a second ago between earnings per share and dividends per share. If you're asked to calculate earnings per share or dividends per share in the question, then you'll compare the two of them. Take the two of them away, what's left is retained profit per share. Dividend cover basically does something similar. Both of them talk about what's the strategy about keeping the shareholders happy. Are we saving loads of money and paying out little dividends, or the other way around? Are we paying loads of dividends just to keep the shareholders happy now and not saving very much? That wouldn't be good for the future of the company. You okay with that so far? All right. Now, the period to recoup your share value. So that means if I'm going to buy a share, or if I'm thinking about buying a share, and it costs €2, how long will it take me? How many years to get back my €2? And I'm either doing it based on how much I would get in dividends or how much has been earned from my €2. Okay? So if the dividends per share is 50 cents and the share price is €2, it's going to take how many years for me to get back my €2? If the dividends is 50 cents and the shares are worth €2, how many years will it take me back to the 4 years? So the longer that time period is, that means the less attractive it is as a way of investing. So if people are thinking about investing money in shares, they might say to themselves, well, look, if that's what the share price is, how long will it take me to get my money back? Because that's what investors will be thinking about, especially if your investor hasn't bought shares now, but is thinking about buying shares in this business. And it's either based on how much it's earning, because obviously if we're earning loads and not paying out much dividends, well, that's still okay, but for the future of the business. But in the short term, I, as a shareholder, might be happy because I'm not getting loads of money back. And the debt equity ratio we've looked at before, so that's how much of a burden our borrowings are. So that's gearing. Is everyone okay so far? Now, what I need you to do now is, I want you to go back and have a look at question 1, 2, and 3. We've looked at 3 headings so far. Profitability, liquidity, and long-term risk, the gearing. I want you to look at the other 4 for the same questions. Okay? Because the questions generally are for B, would the shareholders be happy with the state of affairs of the company? Have you talked about profitability? Have you talked liquidity? Have you talked risk? Now the other then is look at the other 4. So somehow talk about what is the policy of the company. Is it either pay out very little dividends and retain lots, which is good for the future, or is it that we're paying out loads of that profit in dividends? The price structure then talks about, again, we're trying to look at what would be normal in this market. If we're a jewellery store, we expect somewhere around, let's say, 35, 40, 50% profit on every item we sell. So we'll look at our price structure. The industry then, that's where you read the top of the sentence. There's no numbers needed for this one. What do you think the future of that industry is? So if they say it's a construction business, or they're making stuff for the construction industry, do you think the future of construction is good? Yeah. People are going to be building more houses in Ireland. Would you say the future of most businesses next year is going to be better than this year?
Yeah.
Why?
That's not our problem.
Because we're coming out of COVID, a lot of businesses are reopening and the economy is starting to take over. I'm even seeing this now in the last 2 weeks in terms of traffic. When I'm driving to work in the morning, there's noticeably more traffic. So the economy is definitely starting to pick up, and that's going to affect all industries really. Okay? And the last one then is the stock market confidence of the future. Which ratio looks at stock market confidence? Of the list that we have there already.
Stop going over it.
No. Price earnings. So price earnings, so market price of the share compared to the earnings per share. You should end up with a ratio of about 10 to 1. If you get 20 to 1, it means there's very high confidence. The shareholders or potential shareholders, the stock market, thinks that even though this business isn't making massive profits now, we will be making massive profits in the future. So loads of people are going out buying shares. You just invented something, okay? So we're not making profits now, but that invention is going to generate profits in the years to come. The stock turnover is one actually I didn't deal with there as we're going through it. So stock turnover is how often we replace our stock during the year. So it's cost of sales over average stock. Again, back to our jewellery store. An engagement ring worth $5,000. How long do you think that's going to be sitting on the shelf before it's sold? A $5,000 engagement ring. I'd say a month, 2, 3 months. I was talking to somebody who worked in a high-end jewellery store, and he had an engagement ring at one stage was $750,000 for an engagement ring. And that was sitting there in the window for 2 years before he eventually found somebody to come and buy it. Now, meanwhile, he had loads of other much cheaper engagement rings that he was able to get rid of much quicker. So the average time he would keep something is somewhere in the region of 2 months. So that means he replaced the stock 6 times a year. Now again, this is one of those questions where you say, what do you think is normal for this industry? What about the pharmaceutical industry? If you're making medicines, would you expect the stock turnover to be high or low? Do they sell it out quickly or slowly?
Very quickly.
Quickly, why?
People are always sick.
Okay, I agree people are always sick, so we're constantly making stuff, but also a lot of medication has a limited shelf life. So the COVID medication, when they make the COVID medication, it has to be frozen. And it can only be frozen for something like a month. And when it's thawed out, it's thawed out, and I think they have 12 hours once it's unfrozen. And then once they open the vial, it only has 2 hours. So after that 2 hours, if it's not used, it has to be thrown away. So a lot of medication, there's very specific rules about how long to keep it. So stock turnover in medicines, I would expect, is probably in the region of 12 times. So that means we replace our stock 12 times a year, at least. Is that okay? Now again, you're making assumptions here. So your homework then is, I need you to go back to questions 1, 2, and 3. We'll start the second half of our second class. We'll start having a look at the answers to, let's say, the first 2 of those questions. And we're going to finish those next day. Is that okay?